Without a doubt, Charlie Munger is a titan in the world of investing. He is constantly heavily involved in decisions that many people don't comprehend as the vice president of Berkshire Hathaway and the recently retired chairman of the Daily Journal. Munger is actually still very intelligent despite his advanced age, and he will forever be remembered as a legend on Wall Street. The fact that Munger has received such great praise makes it difficult to understand why the millionaire magnate is currently reversing previous teachings. Yes, he has abandoned the exact values that Buffett and he taught and talked about. Charlie Munger, who has previously laughed at the practice of taking out loans to acquire stocks, has committed the cardinal sin of doing so. Is the billionaire stumbling? Could there have been a major error here? Will this occur once more? I'm sure you have questions about all of these, and I'm here to provide the answers. Hold on as I explain how Munger uses margin loans to purchase stocks. But before we begin, make sure to keep yourself informed and engaged by subscribing to the channel, clicking the notification bell, and turning on all notifications so you won't miss our latest uploads. Why did Munger take a margin loan? What is it for? Without a clear knowledge of what a margin loan is in the first place, discussing this topic would be worthless. Knowing what it is will help us understand why Munger previously opposed them. You see, your brokerage firm can lend you money against the value of specific stocks, bonds, and mutual funds in your portfolio, much like a bank can if you have equity in your money. You can use this money, which are known as margin loans, to acquire more stocks or even for urgent needs unrelated to investing. Which stocks, bonds, and mutual funds are marginal can be determined by each brokerage business under a set of rules. Although some high-risk stocks may be excluded, the list typically includes equities traded on the major US stock exchanges that sell for at least $5 per share. Certain investments, such as those from custodial or retirement accounts, are ineligible. Let me quickly demonstrate how it functions for you. For instance, you could purchase up to $10,000 worth of marginal stock if you had $5,000 in cash in a brokerage account that was approved for margin trading. You would spend your own money to acquire the first $5,000 worth of stock, and then your brokerage business will lend you another $5,000 to cover the remaining cost, using the marginal stock you bought as collateral. Your buying power, which in this case is $10,000, is the entire amount that you can invest utilizing margin. What I just described was what Munger did, just on a far larger scale. You might want to round up that $5,000 by a few more zeros if you're really considering how much. See, according to records with the Securities and Exchange Commission, Charlie Munger's Daily Journal invested $118 million in stocks in the 6 months leading up to March. The fascinating element is how this was paid for. During the period, the Daily Journal under Munger borrowed $43 million from its margin loan account and cashed out $81 million worth of other stocks to pay for the transactions. The Daily Journal initially secured $37 million in margin debt in December. They also obtained another $6 million in March. As a result, the total amount of their margin loans now stands at $43 million. These behaviors from Buffett's right-hand man amaze us since we wouldn't even blink if it were any other person. Charlie Munger has consistently cautioned investors against using leverage to purchase stocks, characterizing it as irrational, rash, and akin to gambling. However, the wealthy investor used margin debt to fund a substantial acquisition. Even Munger's partner has always opposed borrowing on margin. According to Warren Buffett, quote, "You'd figured a strategy so that you would have staying strength if there were any market dips and leverage up investments in only ordinary stocks. I mentioned that in my investing career, an index fund would yield 11%. Let's think how you'd have done if you leverage that up to 15%, whatever the growing rates were throughout time. You'd obviously have fantastic returns. Therefore, a leveraged investment in a business would often be an unleveraged investment in a successful business. However, as you point out, the business's use of covenants meant to safeguard debt holders has seriously deteriorated. Naturally, your business market has been strong and you've experienced a period of low interest rates. So, it has come at a very favorable time. In my perspective, what is being bought unleveraged ordinary stocks. However, if you can borrow money, I believe my assets will produce 7 to 8%, and you can borrow enough money at 4 to 5% with no covenants to meet. You'll have some bankruptcies, but in many situations, you'll also have greater profits. It's nothing that even remotely intrigues us. We won't increase Berkshire's leverage." End quote. Buffett discussed the risks associated with margin debt in a letter to shareholders of Berkshire Hathaway in 2017. He displayed a table detailing the 4 significant declines in Berkshire stock throughout the course of its history. If they had been leveraged, the severe losses they would have incurred could have resulted in the firm's demise. The strongest defense I can ever summon against utilizing borrowed money to buy stocks, according to Buffett, is provided by this table. There is simply no way to predict how much stocks can drop in a brief period of time, he said. Your mind may well become spooked by ominous headlines and frantic discussion, even if your borrowings are modest and your holdings aren't immediately threatened by the falling market, because a restless mind cannot make wise choices. Despite all of this, Munger actually did employ margin debt. Charlie was asked the following during the annual meeting of the Daily Journal. Quote, "Charlie, you and Warren have been making concentrated investments since the 1950s. Even more amazingly, none of these investments have resulted in sizable losses despite the fact that many of them have led to profits. I believe neither of you has experienced an equity loss on any investment of more than a few percentage points. Recently, the Daily Journal staked a large portion of its cash on Alibaba and international stocks. In order to fund these investments, it has also taken on an additional $40 million of margin debt. Why are you so confident that these investments won't cause Daily Journal's equity capital to be significantly impaired, which would limit the company's capacity to reinvest the funds required to expand its software operating business?" End quote. Charlie retorted, quote, "Well, of course you have the risk if you invest in marketable securities. You'll lose money instead of making it. In contrast to those who are avoiding risk, we like the ones we have, and we don't mind a tiny little amount of margin debt if you hold a currency that is depreciating and losing power." End quote. It does make sense that he doesn't want to keep the money, considering the level of inflation the country is currently facing. Perhaps the only reason we haven't seen him take such dramatic measures previously is because the circumstances weren't as dire. If this is a carefully considered action, or, as he already said, a careless one that should have no validity. Let's take a brief look at Munger and the Daily Journal's portfolio to see what we can glean from it while we're still talking about them. Munger, according to the Daily Journal, has a portfolio that is worth more than $200 million. This portfolio consists of a small number of stock selections, and over the last few years, it has seen very little activity. This describes a buy and hold kind of portfolio. Only one swap to the portfolio occurred in the most recent quarter, the first quarter of 2022. This manifested itself at a huge magnitude. Munger sold more than 300,000 shares of the stock, cutting his stake in the Alibaba Group by more than 50%. E-commerce and technological infrastructure services are offered by Alibaba Group Holding Limited. The company offers businesses, brands, retailers, and merchants the essential technological infrastructure they need to market, sell, and run their operations online. It's a Chinese corporation that has recently been at the center of a lot of controversy. Due to the e-commerce stocks' almost 50% decrease in the year to March, Munger liquidated the shares he had purchased when he purchased the investment in Alibaba last quarter, suffering a loss of $33 million. I believe that Munger took a calculated risk, given how the Chinese Communist Party has been interfering with the company. The portfolio solely underwent this alteration. The remaining positions have been steady and unchanging. Let's take a closer look at that stock that is being held. The Bank of America Corporation is by far Charlie Munger's greatest holding at the moment. This holding, with approximately 2.3 million shares, accounts for over 45% of the Daily Journal's total portfolio. A worldwide American investment bank and holding company for financial services, the Bank of America Corporation is based in Charlotte, North Carolina. With a book value of approximately $95 million, it is a reliable choice, and it is clear why this is his first choice. Wells Fargo follows this with approximately 1.6 million shares. This stock represents slightly over 36% of the entire portfolio position. This is valued at somewhat more than $77 million. Wells Fargo is a well-known company, much like the Bank of America. But in case you're unaware, Wells Fargo is an American international financial services firm, much like Bank of America. The fact that these two top picks dominate the portfolio and offer comparable services in comparable industries proves one thing: invest in what you know. Munger is definitely carrying that out. After being reduced, Alibaba Group Holdings is now the third largest holding. Of the Chinese stock, Munger still controls 300,000 shares. US Bancorp, which accounts for 3.5% of the portfolio and has a valuation of slightly over $7 million, comes next. This is made possible by the 140,000 stock shares that are held. US Bancorp is a Delaware-incorporated American bank holding corporation with headquarters in Minneapolis, Minnesota. The fifth largest banking organization in the United States, it is the parent business of the US Bank National Association. Munger definitely has a fondness for the financial services industry, and it makes sense why. He excels at that. POSCO, which is by far the smallest of Munger's holdings, is his final holding. POSCO closed the Daily Journal portfolio with little over 9,700 shares, or 0.27% of the portfolio, valued at nearly $577,000. The corporation, with its headquarters in Pohang, South Korea, manufactures steels. So there you have it, guys, a thorough view of the Daily Journal's portfolio. Given that they recently made a 15-fold profit on a $3.3 million investment, we can see that this is extremely indicative of the Munger approach of investing. And it's working. Time will tell if the margin loans have any effect on his profits at all. Thank you so much for watching. If you like this video, please remember to like, share, and subscribe. See you guys in the next one, and remember, keep living life bullish.